Hi everybody. Today we have published our second edition of our Global Monetary Conditions Monitor, our flagship monthly publication on global monetary affairs, global monetary developments, and I'll give you a little bit of a sneak preview on some of the conclusions and some of the point of views in the monitor. First of all, I think the headline maybe gives away quite a bit. There will be no more rate hikes from the Federal Reserve in 2017. Well, is that a forecast or is that a recommendation? You can see it as a bit of both. Overall, our view is that monetary conditions in the US is fairly close to neutral, but it's nonetheless on the tight side relative to achieving the Federal Reserve's 2% inflation forecast. In the monitor, we do forecast inflation for 25 countries based on monetary conditions and recent monetary trends. And for the Fed, monetary policy has actually tightened slightly since the rate hike in March, and maybe more importantly, since the Fed came out and said in its minutes from the March rate hike that there was discussion about normalizing the Fed's balance sheet. If we look at inflation expectations in the US and in Europe has come down somewhat since then. That combined with the message from our Global Monetary Conditions Monitor, we conclude that the Fed is likely to continue to undershoot its inflation target also on a 2 to 3 year horizon. Consequently, we see little need for further rate hikes. At the moment, the markets are pricing in a little bit more than one rate hike this year, but actually we would think that it's more likely now that there won't be any rate hikes at all. And that wouldn't be too bad. If we look at Europe, we are beginning to be slightly concerned that the peer pressures from the US is increasing pressure on the ECB to step backwards. There's no doubt that Mario Draghi, the ECB chief, wants to continue present policies, but over the past months we also heard voices, particularly Bundesbank chief Jens Weidmann, coming out and say the ECB essentially should also normalize the balance sheet, stop quantitative easing and maybe hike interest rates. And we've seen that in Eurozone inflation expectations coming down. That being said, if Draghi is successful in continuing present policies, we think the ECB is on the way to continue to deliver around 2% inflation going forward. In the Global Monetary Conditions Monitor, we also highlight countries which we believe have overly tight monetary policies or overly easy monetary policies. In terms of the countries failing on the too tight side, I would particularly highlight the Bank of Japan, or rather the Bank of Canada, which we think has too tight monetary conditions, and the Bank of Canada hasn't been very eager to do anything about it. So we do see some risk that the too tight monetary stance from the Bank of Canada will further increase financial distress, as we actually have seen in recent weeks in Canada. On the other hand, we have countries where monetary policy, in our view, has become slightly too easy. We highlight the Swedish Riksbank and the Bank of England as central banks who really should move in a slightly tighter direction, and if present stance are continued, will overshoot their inflation targets on a 2 to 3 year horizons. For Sweden and for the UK, we are not in a situation where we are facing runaway inflation, but nonetheless, the central banks of these countries ought to move in a slightly more hawkish direction. As it looks presently, certainly the Swedish Riksbank is not agreeing with us. If we look at Iceland, we are seeing monetary conditions becoming quite significantly too easy, and it more and more looks like we are facing some kind of boom-bust scenario, not for the Icelandic economy necessarily in the sense of what we saw in 2008, but at least inflationary pressures are building quite dramatically, and we could be in a situation where inflation could hit 4% by the end of 2019, according to our forecast, if monetary conditions is not tightened. So overall, there's a lot of interesting stuff you can find in our new Global Monetary Conditions Monitor. We highly recommend that you subscribe to it. You will find more information about that on Markets and Money Advisory's website. And if you have any questions, please contact us.